Now, tell me, your approach to quant investing is quite interesting and quite different than what Siddharth and Sonam are practicing. So why don't you talk about your approach a bit and how you are using quant in providing the personalized advice that you are providing?
Sure. So I'll divide this question into two parts. One is the approach and how do we personalize, basically. So in terms of the approach, like I said, the first ground truth that we begin from is that we don't understand a lot about the market, right? So we need to understand that first. And especially because reason and consequences may not always be directly correlated, or maybe even we might not even have the ability to pinpoint and say this was the reason. For example, you might have a bad quarter and the stock rises, basically. And you had a great quarter and the stock goes down. So if it were as simple as a mathematical formula, then it should follow a certain coherence across different situations. So there is much more than that. So there are multiple different layers of complexity that we believe is there. So what we do is, one, to give as much autonomy to our system as possible with the least number of rules, right? So we don't tell the system that, for example, quality means your ROCE has to be a certain percentage. If I say 15%, why not something that's 15.8 or something that's 14.2, right? So you're hard coding your bias into the system and expecting a different result, which won't happen, basically. So we let our systems define what parameters are important and also the ranges or the optimal values that will actually create alpha, or are having a higher probability of creating alpha. So that certain understanding that there's a lot we don't know, let the system define it. Of course, it sounds a little scary that we are leaving it completely to the system, but these are supervised systems as well. So over time, we've been able to come to certain conclusions, whether it is industry level clustering or understanding what could be the likely winners within a particular sector, how to differently analyze each sector. I think these are different models that will come together, not a single model, not a single factor, not a multi-factor with a singular strategy, but these are multiple strategies that will come together. I think that's in line with what Siddharth was saying. So that's the part one. So give as much autonomy, give time, give great data, and that's a stepping stone. The second part, how do we customize, and why do we even customize? So when I first looked at the advisory space, and when we looked at how advice was communicated to the client, I was very astonished that the advisor had a list of 10, 12, or 14 stocks, a kind of a portfolio, and that was being circulated to all clients. Now the advisor or the fund manager might be spot on with their research. There's no problem with that. The problem could be doesn't fit the client's profile, basically. So somebody is investing for 5 years, 7 years, or 10 years. These are all long term, but they're all not the same, right? So you could absolutely be right about a certain business, but it may not pan out in the time that the client needs to get out of the market. That's one example. And there's a lot of such things that need customization. And there was a discrimination in terms of, if you have a higher amount of capital, we'll give you bespoke service, right? But for a retail client, that wasn't available. So that's where we started. And we created a risk profiling system called EFG, the emotional, financial, and general analysis. So this was a psychometric tool that we developed because we understood that clients did not actually understand the questions that we were asking many times, or they were not able to give us an accurate answer. For example, our question was, how much would you risk losing, or how would you rate yourself in terms of risk appetite? I never met a client who said my risk appetite is low, right? So everybody said my risk appetite is high. But until when the market crashes is when you know who has a high risk appetite and who has a low one, basically. So instead of asking just straight dumb questions, we started analyzing their behavior. How do they interact with our system? How many times have they changed their answer to our question? What's the time they have taken to respond? How are they responding to our advice, or in the case of our PMS, right? So we execute, so that issue is not there. So we analyze all those factors, create a profile. That profile then coordinates with our quant and iris system to actually give that portfolio, basically.